Welcome, everyone, to our Perspectives on COVID-19 and the State of the Global Markets webcast. I'm Mike Minter, and this presentation is brought to you by Financial Synergies Wealth Advisors. We're pleased to welcome our guest expert today, Apollo Lupescu, Vice President at Dimensional Fund Advisors. As many of you know, we do use DFA funds in our portfolios, and Dr. Lupescu is responsible for communicating Dimensional's academic foundations and investment beliefs to financial professionals and individual investors. He's considered the secretary of explaining stuff at DFA because he excels at delivering thought-provoking presentations in a clear and understandable way. Apollo's been with Dimensional since 2004, and prior to that, taught at the University of California, and he had his own consulting firm. Apollo received his PhD in economics and finance from UC Santa Barbara. He holds a BA in economics from Michigan State University, where he also competed and coached water polo. So Apollo, what are we to make of all this coronavirus, craziness and the impact on the global markets? And, what is your perspective on all of this?
Right. Well, first of all, Mike, hello, and thank you so much for having us, and thanks to everyone who will be watching this. It is a pretty crazy time. There's no reason to sugarcoat it. It is quite different, and what I find interesting is that this crisis is not only impacting the markets, which are forefront, because it seems that every day there's a new notification, or in the news you hear about what happens on the market, and it's not always pleasant. But then there's also the health piece of it. And I think it's touching all of us because we do have either family members who are vulnerable, or maybe they have been through this. My very, very close family has been through this coronavirus and COVID-19. So it is impacting us not only on the money side, but also our psyche and our emotions are deeply touched by the health aspect of it. And I can't say thank you enough to all the healthcare workers and everybody who gets up and goes to work and treats other patients, knowing that their own life is at risk. So, thank you. It's an amazing story, and they are the heroes of the day, and not just today, but in general. So to put some context beyond even the health, you have the economic impact, because we all walk outside and we see restaurants are shut down. There is no traffic. Life is not exactly what we know. And that all that has an impact on us. And the place to start, in my opinion, is to look at the human element and how all this is impacting us as investors. Because there is a rational piece to all of us, and there's we certainly have the rational investor in all of us. But the decisions that we make as humans are not always driven by the rational side. Let me explain what I've seen happen in the market and with investors. For about 10 or 12 years after the great financial crisis, what we've had is a pretty steady rise in the U.S. market. And I will consider the S&P 500 index is to be the measure of the U.S. market. And over these 10, 12 years or so, what we've seen is a pretty steady climb, where what's been remarkable is how unremarkable these 10, 11 years have been. Because when we look at and you study the stock market, you see there's a certain level of volatility, which basically means that the value of the market fluctuates. It goes up and down, and that's what volatility reflects. And over the past 11 years or so, it has been a little bit more quiet than usual. It's been unusually quiet relative to the historical norm. And I think that what's happened is, to many investors, the stock market there's not much to see. Goes up a little bit, another bit, and then eventually there's a quick pull down, but there hasn't been anything remarkable for a while. So people not only were happy to look at their statements and say that it looks pretty good, but also got comfortable with the idea of buying into stocks and buying into the market. So in that respect, not that people were conditioned to believe that that's the norm, but I think it got some to believe that maybe the stock market's like a warm, nice little pond that you swim in, where in fact we know that it's more of a rougher ocean. And what happened the last few weeks is that we've seen this pretty significant drop in the market. And not only that, people have become unhappy about looking at their statements and the value of their accounts, but at the same time, it has allowed some of the emotions, the human emotions, to resurface. And I think that one of these emotions is something that has allowed us as a species to survive, which is the sense of, being afraid. If there's an animal behind you, well, you're afraid, you're scared, you run, and when you flee, that saves your life. And in the case here, what we've seen quite a lot of investors is going from maybe concern to maybe anxiety, all the way in some cases to being fearful of this scary thing called the market. And the way to flee to safety was to basically consider selling it and just get out because it doesn't seem to be a safe place for my money. And I think that what's interesting about this cycle of emotions, and you compare that with the analytical side, they're quite the opposite. Why? Because the analytical person, the analytical investor would say, well, to make money in investing, you should buy low and sell high. That's the fundamental premise of investing. It's very simple. Everybody knows it. And yet when you look at what the emotions sometimes make people do is typically buy when things go up and everything looks good. So you're buying at a pretty high level. And then when the market drops, that's when you think about selling, and you're selling at a low. So the rational investor says, you should buy low and sell high. And the emotional one, well, let's buy high and sell low. So to me, it is not about negating emotions. That's what makes us human. It's absolutely okay. It's absolutely fine to feel the way you feel. Absolutely. I think the only consideration is that work with an advisor who acts like a coach to make sure that you disentangle emotions from investment decisions. And when you do make these decisions, that they are rational rather than being clouded with emotion. And that's I think it's a fundamental thing that I've seen resurfacing of all these emotions and people making decisions, not necessarily because they've analyzed and they crunch numbers. It's just emotionally that feels like the right thing to do. And the last few weeks, we've also seen that these cycles in the market have shortened. What used to take weeks or months in terms of market movements, and they're now within days or even within a day. And the movements are also steeper, going from up to down. I think in March alone of 2020, we had 6 days in the market when it went up above 4%, and 6 days when it went below 4%, negative 4%. So it is the movement. It's quite large. So actually, if you even look at it, it looks a bit like the roller coaster. It is the roller coaster of investor emotions. But the same way that when you're on a roller coaster, your stomach might be turning as you're on the roller coaster. You are better off staying in your seat rather than try to jump out in the middle of the ride. And that's I think that's a pretty good place to start, because it does reflect on kind of like the psyche and what actually drives humans to make decisions. And I find that emotions are quite often a stronger impetus for an action than the logical research. Beyond that, what we've also seen is that there are some investors out there who are looking at the market and kind of wondering, why is it that it's dropped? Is there something wrong with the market because it's dropped so much? It seems like anytime something loses money, there's something wrong. So what's wrong, and why is the market losing money? And let's answer that question. Are the markets functioning well when they drop? And to understand that, let's take this S&P 500. And in fact, let's just demystify what is the market, because quite often you hear somebody say, well, it's taking a breather as if it went for a ride and now it's needs a little rest. So what is the market? Well, the market is basically a way to look at the value of different companies in the US economy. And there are two major ways in which the popular media is convening the idea of a market. One is the Dow Jones Industrial Average. That's probably the most common among media outlets. And what it is that what the Dow Jones did is what it's doing right now is taking 30 companies in the U.S. economy. These are large, blue chip, well-established, mature companies. And it's looking at their value and how that value changes from minute to minute, or from day to day, month to month, year to year. And that kind of gives somebody a sense of not just any one company, but a group of them. The thing with the Dow Jones that it's not always used by more rigorous research is that in the U.S. market, there are about 3,000 different companies. And what the Dow Jones reflects upon is only 30 of them. And in fact, Amazon is not even part of it. So that's why we're choosing to look at the S&P 500, which is a broader set because there are 500 companies, and it's more reflective of the overall U.S. economy and the U.S. Stock market. So what we see is that the value of these stocks altogether comes from the changes in the values of these underlying stocks that are part of the S&P 500. So why would the value of a company change? And what does even the value of a company come from? Well, the basic premise of the stock market is it allows all of us to have a stake in capitalism because it allows us to buy ownership into companies. If you buy a share of stock for Apple or Amazon, Google, McDonald's, Coca-Cola, Shake Shack, you name it, then you become part owner in that company and you have a piece of that ownership. And as part owner, you are entitled to part of the profits, the cash flows that the company will make 1, 2, 3, 5, many, many years down the road. So the value of a company really reflects upon what are the cash flows, what are the profits that investors are expected to receive. I pay some money now and I expect to get some money down the road. And so it's fundamentally, by and large, the value of these cash flows, of these profits that drive the value of the company. At the beginning of the year, there was an expectation of these profits, or a range of expectation for these profits. But as the crisis unfolded and we got to where we are today, it became really apparent and obvious that these companies will not be able to realize the profits that we expected before this crisis. So what the stock market's simply doing is just reflecting that the profits that are expected now are lower than what we thought at the beginning of the year. So naturally, I won't pay as an investor as much for this company because you won't make as much in profits as I thought at the beginning of the year. So a market drop is just simply a reflection of the fact that companies' profits fluctuate. They always have, and they always will, because that's just the way that the world works. There are things that happen that either increase the value of future profits and cash flows, or decrease them. So what we're seeing it by the fact that the market has dropped is not a sign that the market's not working. It's pretty much exactly the opposite. It is a sign that the market is working, because I would have been surprised, if not shocked, if the market had not dropped. Of course, these companies are not as valuable that as a whole, then you should see the market drop. So in that respect, the markets are functioning really well and reflect the fact that the expectations for future cash flows are now lower. Now, what about this idea that have we reached the bottom? And everybody seems to know that the market will continue to go down. Well, I would actually have a bit of a different opinion on that, because right now in the market, there is perfect disagreement among market participants. In other words, there are millions of deals being made every day between people who want to get rid of their shares of ownership and the ones who want to acquire them. And what has to be true is that for every seller, there has to be a buyer. For every pessimist, there has to be an optimist. Because supposedly the people selling believe that the market will continue to go down and it's time to sell. But the people buying have exactly the opposite opinion. I'm buying now because I think it's going to go up. If I know, or if everybody expects that the prices will go lower, well, nobody would buy at these prices today. So what's beautiful about the market that's still functioning so well is the stock market and the market in general is probably the best way to put together all these pieces of information that people have, all these expectations, all these forecasts, some more positive than others. But ultimately, what you're getting with the stock market is a machine that aggregates everything and combines all of these into this one beautiful thing called the market price. That it's reflecting not only the opinions of the pessimist, but also the opinions of and the views of the optimist. And that is still in place today. Buyers and sellers can still trade. The volume hasn't dropped to the point where you say, well, these people can match them with each other. No, these millions of deals are cut every day in the market between buyers and sellers. And that is, in a way, probably the best way to think about the market. If you want to know what will happen to the market tomorrow or the day after or in 6 months, what you need to understand and reflect upon is that whatever is known about these expectations on COVID or whatever the case might be, people know these. They have very sophisticated model to make future forecasts. But what is important is that when something new comes out, a second from now, a minute from now, whenever new information comes out, all these market participants will incorporate that information extremely quickly and adjust their forecast, adjust the expectations, and that will adjust the price. So whether the market goes up or down a second from now, a minute from now, a day or a year, it really depends on what is the information that is currently unknown. And if that information sounds like good news, let's say there is a new testing that will allow the economy to get back on track faster than we thought right now, well, that would likely increase profits of companies. The markets will go up. So all of this, it really depends on news that's not known today. But all the information that we know today is already baked into this market price. And what we believe is that when you have all these millions of market participants, all these deals being made with billions of dollars, that is probably the best way to gauge of, what's the overall view, not of any one person, not one single opinion, but rather all of them combined. So that's once again, we do believe that the markets are functioning well because of all this. But ultimately, what I want to touch on before I kind of turn it back off, because I know that it would be fun to get some questions, is what should you do now? What are the things that an advisor or an investor should do? And there are two basic strategies that you have. On one hand, one of the strategies might be to say, well, what if I sell now and I wait it out, and then when the storm clears, then I can get back in the market, because it doesn't seem like the economy is going to be very good. And that's certainly appealing to some people. I think that when we studied this and we looked at this over and over, I spoke to countless investors and managers who have tried something like this. There are some considerations if you're considering this, if you're pondering this strategy. The first one is that if you decide to sit this one out, you have to make an equally important decision at the same time. Not only when to get out, but when to get back in. And I'm not aware of anybody who can consistently make these two correct decisions. And you need to make that, because otherwise, what tends to happen, and this is what we see more often than not, is that by the time the economy recovers and things look bright again and the storm has passed, quite often what you see is that the market by then could already be up. We don't know, but it could actually rise. And what happened in 08-09 is a good example, is people who at the beginning of 09 saw that economically it's a very dark year ahead, which it was. It was the worst year of the economic downturn in the financial crisis. Unemployment was high and economic output was low. People who said that one out and said 2009 economically is going to be a disaster, they were right. It was a disaster. The thing is that the market in 2009, the U.S. stock market, the S&P 500, actually went up just about 25% or so in that 1 year. And if you're waiting for the smoke to clear, well, what you've done in effect is take something that could have been a temporary paper loss and now turn it into a permanent loss, because you'll never be able to recover that. And there's one more thing that I'll touch on. Talking to so many people who've done this, if you think that the stress of investing is eliminated because you sold, what I found is that the stress of being in the market is very quickly replaced by the stress of being out of the market. Because when you have really good days or good weeks or good months in the market and you're sitting in cash wondering, when do I get back in? That could be extremely stressful. So what we're suggesting, I think what the strategies and what we share with most institutional investors, and I think the academic community has embraced this way of thinking, is that what investors should do is first of all manage the expectation and really understand what it means to be invested in the stock market. And to begin with, historically in the U.S. stock market, as the S&P 500 index, if you look over the long run, 10, 20, 30, 40, 50 years, whatever number you do on the long run, what you see is that on average, historically, the market has grown by about 9 to 10% per year. So the average annualized return in the US market over the long run is 9 to 10% per year. Just roughly speaking, these are rough numbers. There's certainly the advisors can give you much more precise numbers, but roughly speaking, it's in the ballpark for the S&P 500 index. It turns out that that's the average per year, but please don't expect it every year, because from year to year, this is what it looks like. It's a very, very choppy ride. And that's just the way that the stock market works. Profits fluctuate. You have economic cycles. For whatever reason, something happens. You'll see the market bounce up and down. So that's the roller coaster that I'm talking about. But there's also a very rewarding part of the of being invested, because rewarding, what I mean by rewarding is that the price of admission is volatility. But once you stay on the roller coaster, and my dad, let's say he's 93 right now, if his parents had put $1 back in 1926 into the market, and he was on this roller coaster through the Depression, wars, good times, bad times, the question is, what would that dollar have turned into by the time he turned 92? He's 93 today. Well, there's a book called The Matrix book that it's certainly a phenomenal book. It's a big book of numbers. And it kind of tells you that $1 invested in the US market, left alone in my dad's lifetime, would have turned to roughly, and again, these are rough numbers, about $7,000. So it's a really nice growth in the US market. Now, on the other hand, what you want to do is maybe have a little more stability. If you're close to retirement, or just your risk appetite is different, how can you achieve that? Well, instead of buying ownership in companies, you can, use something called bonds, which is a type of a contract where you lend your money, you lend your assets, your capital to governments or companies. And the one issuer that has never missed an interest payment or a principal repayment on these contracts is the U.S. government. So if you look at something that's short term, let's say a month, you lend the money to the government for a month, that is called the 30-day treasury bill. And you look historically, what you see is that historically these treasury bills have also had much lower fluctuation in value relative to the stock market. And in fact, in the Matrix book, I could not find a single year when, from a calendar year perspective, these treasury bills, the 30-day treasury bills, had a negative year. So if you want to consider something else than owning companies that have fluctuating profits, you can lend your assets to corporations and the governments in the form of bonds. You get an interest payment that's in the contract, a specified period of time, and at the end, you get your money back. And if you look at these 30-day treasury bills, historically, they have given investors just a little bit above inflation, which is about 3-4%. Inflation historically, roughly speaking, has been about 3%. This has given just a little bit above that. So there is an instrument out there that you can balance the choppiness of the stock market with something that gives you more preservation of your assets. But to see the dynamic and how different it is, if you had gone on this little roller coaster, the Legoland roller coaster, if I can just make an analogy, it's quite different. The same dollar over roughly the same period invested in the treasury bills would have grown to a much lower $21. So there is a trade-off between preservation of capital and growth of capital, and that's why having a balance between stocks and bonds tends to be the most important decision for most investors. Now, if you ask what's the right balance, there is no optimal balance. Rather, the only way to do it is to sit down with an advisor at Synergy and really look and say, for my circumstances, for my family circumstances, given my age, how much money I need, when do I need it, do I have a pension or not, what's my risk capacity? What ends up happening is you need a financial plan. And when you have that financial plan, then you're trying to look and see, given what my objectives are and my risk capacity, what's the right balance between stocks and bonds. But only once you have that plan, you can make that determination. The second thing you can do is not only invest in U.S. companies, but you can go and see that around the world there are other opportunities. And if you're to redraw a world map, not based on landmass, but the value of all companies that you can buy and sell, this is what the world will look like. The U.S. has roughly about 3,000 different companies, and accounts for about 54% of the value of all stocks. Around the world, there are roughly about 40 other different stock markets that you would, roughly speaking, there are 9,000 plus companies operate and can be bought and sold on different stock exchanges. So one of the ideas is that you want to have a cushion, which doesn't guarantee anything, but what it does, it basically says what we've seen in the past is that when the U.S. is not doing very well, it is possible that some of these countries might actually hold you up. And in that Matrix book, you also see that it's quite random from year to year what countries do well. What this shows you is every column is a year, and then every country has the same color throughout. So, if you look in terms of patterns, the best performing countries on top, the worst is on the bottom. And at least from my viewing, from my observation, I can't say that there is a pattern that would tell me which country will do best the following year. But it's quite random. And I think that at the end, when you put all of these together, what you do by buying pretty much all of them, you avoid extremes. Because by its nature, if you combine all of them, you're never going to be the best or the worst. You're going to reduce a bit the extremes of investing. So that's the second thing you can do: bonds, international stocks. And the third one is to have an advisor like Synergy who, before something happened, they put in place a plan. When this crisis happens, when there's a market downturn, they're not trying to figure out on the fly what to do, but they already have a predetermined way of handling it. And one of these typical piece of a plan is looking at the balance that the clients have in their portfolio based on the financial plan. And if there is a stock movement and the stocks drop, then the idea is that you want to bring that back to the right balance between stocks and bonds. So you always want to maintain the balance between stocks and bonds that was determined in the financial plan. And that requires monitoring and careful consideration when to execute it. And that process is called rebalancing. And rebalancing, it turns out that it has it's keeping the portfolio in optimal levels, and you do have to pay attention. You have to do it very carefully, and that's part of the value add that advisors have. So those are some of the comments that I wanted to at least get us started with. And I know I've been talking for 20 minutes, 25 minutes, and maybe a good place to pause and turn it back over to the team.
Hey, Apollo, thanks so much for your remarks. This is Brian Chisha. Something that we often hear from investors is how unprecedented the current events are. And while things certainly are different in this crisis, I'm wondering if you can share some lessons that we can draw from the past to kind of help investors better cope with the current situation.
Right. And I think it's a well said statement. This is pretty unprecedented, and I think it would be disingenuous for us to say, "No, we've seen this before." It's really not that often, and I'll tell you one of the ways that I've looked at this. We've had market fluctuations before, and I'll touch on that. But what's interesting about this situation, that what the coronavirus has done is, and in terms of lessons that we can draw, I think what's interesting is that this is not only a typical downturn in the economy, because in a typical downturn, you do have what's called a demand side shock, which is that the three components of economic activity, the three groups that actually generate economic activity, consumers, companies, or the government, if they're cutting spending for whatever reason, unemployment gets high, companies don't spend that much, maybe the government is cutting back, all this is leading to a reduction, a contraction in economic activity. And there are ways to stimulate, whether you have tax cuts or you do government spending, whatever the case may be, you can start to stimulate the economy to get back to a higher output. The thing that we have now is not only that demand side shock, because people are just not spending as much, but you also have a supply side shock, which is caused by the fact that the economy can produce. workers are stuck at home, so factories and the economy can produce. And it's that's what I think makes this more unprecedented, because most often what we see is that typical demand only can be addressed through monetary and fiscal policy measures. But this one doesn't happen that often. And in fact, looking through the history books, the economic history books, there are probably only 3 times to my knowledge, I can think of situations like this that would help us maybe give us some guidance and draw some lessons that are really pertinent for where we are. The first one is 1919 to 1920. Actually more like 1918 to 1920, which was a global, well, not a global, it was a global, actually. It's a global pandemic that's called the Spanish flu. And what's interesting about that is that, the world was different then. Whether it's medicine, technology, the way everything operates, there's no doubt. But what's interesting about that as a lesson is that back then, the way the government dealt with it, and the way government means cities, because it was quite decentralized, similar to what we have today, is that it was eerily similar also in the way that they tried to contain it. And in those days, they were very similar lockdowns, quarantines, people being asked to wear masks in public, required, in fact, to wear a mask. Everything, all the restaurants, everything shut down, churches, schools, everything was pretty much in the same time of social distancing that we have today. They went through that exactly 100 years ago. And there's a recent paper that looked at the lessons from there. And one of the lessons was that the cities that actually took care of the problem, and they acted early, and they kept the lockdown in place a little bit longer to make sure it's over. At the back end, what this paper suggested is they ended up better off economically. It was written just published maybe a few weeks ago by 2 economists from the Fed and a PhD from MIT. So I thought it was interesting as a lesson for today is that they did revive after the Spanish flu, of course, but taking care of the health crisis is the number one thing before you can fix the economic one. So that's a lesson that I think we can draw from there. And just as a curiosity, the average length of a city lockdown back then was 90 days, 3 months. Some cities were as short as 60, others as long as 120. So it is a good lesson. So that's one time. The other one is World War II, because in World War II we had about 11% of the workforce being drafted to go to war. And once again, you had a big supply shock because 11% of the workforce is no longer in the workforce. And the way that we kind of looked at that was, in the ingenuity and the spirit, was to replenish the workforce through women. In the fact that up on that time, it wasn't the norm that both men and women worked, and this kind of provided an opportunity for women to work, and they stepped up tremendously. And you remember all the posters like "Yes, we can" and Rosie the Riveter, and that's really helped the economy back then. And the third time is probably the supply shock of the oil crisis in 1973. And once again, there was a time when OPEC had an embargo against the U.S. and we didn't get the oil, and we did have a pretty big, major downturn. A lesson from there is that we went from being dependent on foreign oil today being the largest oil producer in the world. And perhaps one of the lessons here is that if we fast forward 20, 30 years, this might have been the impetus of a revival in U.S. Manufacturing. So there are lessons from the past, but not that many in terms of having both a demand and a supply shock.
Hey, Apollo, I really appreciate you spending a little time with us today. And I love what you had to say about previous downturns going all the way back to 1918. As I think about the history of our market, what we've been through, all of the various downturns, what I'm wondering is about specific financial data. What lessons have been learned from those downturns, and what data can we use to really anticipate what's ahead? So many people, so many of our clients have questions about what they can expect going forward. So what have we learned from the past that we can take home to them?
Yeah, no, it's a very important question, because all this ultimately starts to reflect on the market, and we absolutely have looked at this. We've done some research. We have a phenomenal research group, so many PhDs who have looked at this, and what you see is that historically, in the U.S. market, we have not consistently had just up, 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 up. Every once in a while, when you do put a threshold of a 20% for a downturn, what you see is that you have a sequence. It's not something that's predictable, but without a doubt, there's a sequence between, what public domain is called as a bull market or a bear market. And what you see is that by and large, you have bull markets that last, in this case, could last for 10, 15 years. But you also have periods of bear market. And just as an observation, looking at the visual, what you see is that by and large, the bull markets tend to last a little bit longer. And I don't know there's an average that we can look at, but just visually here, it seems like if you say, let's say 10, 12 years, there's on average, there's a 20% bear market drop with a downturn. We're pretty much right about there, because we've been about 11 years in a pretty good bull market, and now we have this happening. So in other words, it's not terribly unusual to see that every once in a while there's a pullback in the market. That's not terribly unusual to see. And again, we looked at this. But the next question, which is kind of tied in there, what lessons can we learn? What happens after we see some of these downturns? And once again, we ran some numbers, and what we found is that if you fast forward, if you now go and look 1 year ahead, or longer, what you see is that historically, we know that it's been about 9 to 10% on average per year. But if we do have this 20% market decline, what do we see afterwards? Do we see on average that the market continues to go down, or does it go up once we see this 20% market decline? And when we ran the number, is there are different periods, as you saw that there's a 20% downturn, and on average, once we saw a 20% decline, on average, the market from that point on, over 12 months, it tends to go up by an average of about 14%. So what we see is that it's on average, we see that the market goes up and by more than the historical long-term average, and that is sustained over 3 as well as over 5 years. So this, nobody can tell. I mean, every downturn is different, but it is interesting to look at the data and to see that on average there is no sense of panic that this lasts forever and ever and ever. There are periods when it could last for a long time, but on average, after 20% downturn, it seems like it is coming back. That's what the data suggests.
Hey, Apollo, it's Mike Minter. So one of the questions we get from time to time is, with the decline in economic activity, which we've seen has been pretty dramatic here lately, and now this kind of a historic unemployment rate. The government and the Fed have taken some pretty significant steps over the past few weeks. So, is the U.S. in a recession, and did these actions help? And how did it impact the markets?
Right. No, it's certainly an important question, because you mentioned that you read the numbers, and there are millions and millions of people. I think the number that I read is like 20 million almost people who are, or 20 million people who are unemployed. And the sad thing is that every single one of those people is a life that was disrupted, and it's just incredibly sad. Hopefully this will not be a very long lasting period when these folks are out of work. But what I think, to your question about the historic unemployment, it's hard to gauge, because, as I said, we have both a supply and a demand issue here. And what the government is trying to do is not necessarily put in place a stimulus package, because a stimulus is trying to stimulate the economy. In this case, you can't. Because even if you give people the money and you ask, go spend it so the production and the economy increases, that's not possible, because the workers are stuck at home. So what this has been more than anything is more of a what's been considered a liquidity package. So let's provide some liquidity in the economy. And I'm not sure that I want to go into all of these, but I'll give you my 2 cents on the matter. The first one is that the liquidity, I think it was necessary because you have so many small businesses that are viable businesses. It's just that for the next 2 or 3 months, they just need to get through this. And once we're through this, they can operate again. And if these businesses have to lay everybody off, and if these people have to start over with a new business, it's going to be a lot harder. And I think what this bill is trying to do, the goals of the bills are really, in line with the economic theory. Let's provide some liquidity. Let's get through this right now, and then the economy will rebound faster than if we didn't do anything. So I think that both. From an economics perspective, you see that you hear that it's in line with the theory. We had a great seminar with Professor Ed Lazier from Stanford, and he was the head of the Economic Council during President George W. Bush. And what he suggested is that all these are pretty much things that will help the economy. Whether or not it's enough, it's the last one. It's hard to tell. But to me, the way I look at it, I'll tell you the way that I looked at it is that the house is on fire. Let's not worry about getting the carpet wet. We'll deal with that later. Let's just put out the fire first, and then we'll work it out. And there are going to be some people who might take advantage of this, without a doubt. But I think if you start to split hairs, which I don't have, but if you start to be too granular about who gets it or doesn't get it, you miss the opportunity to act with the level of speed that's required right now. And by all measure, people are saying that the fact that both the Fed and the government have acted fast has been a really positive outcome, because there were lessons that were drawn from 0809, and they're being used right now.
Hey, Paulo, this is Mike Booker. I want to thank you for your time today and really the great facts that you're putting out there, the great data, which kind of leads me into my question. There's been such relentless coverage of the markets, along with the recent big fluctuations in the market, that have made some of our clients pretty anxious. I think that clients should stay current on what is going on in the markets, but can you share any strategies with us today that would help our clients cope with all the noise that's thrown at them nonstop?
Right. No, and it's it's a great question, because it's hard for me too. I receive notifications every day. I don't know why. I never asked Apple or Google to send me what the market did today, but I can't escape them. And they're coming, and it's always kind of staring in the face. So it makes it very hard. I think the first thing that I would tell your clients is that one of the benefits of working with Synergy, one of the benefits of working with an advisor is to call them, because they are your coach. All successful people, from CEOs to athletes, they all have a coach, and you have a coach as well. And whenever this anxiety, whenever concern comes up, rather than try to satisfy it through watching more media or Googling things, pick up the phone and call the advisor. That's part of their value proposition. And I think advisors right now are pretty much like firefighters. When things are good, you get ready, but you really, this is not a dry run. Right now, they're earning their keep because they are providing coaching and help support through these really tough times. The second thing that I would suggest is go back and talk to your advisor about the financial plan, because what most likely you'll discover is that if you are in retirement or you're close to retirement, there's a very good chance that not all your money is invested in the stock market, and there's a balance there. And the results that you're seeing for your own account are likely to be different than what's on the news. Just because you might have some bonds in there, you might have some international stocks, some emerging market stocks, you might have some real estate stocks, you might have some cash. All of these decisions that are made through the financial plan might make your plan, your experience look different than what's in the news. And the third is, I would encourage people to look at the stock market a little bit, in generally speaking, a little bit as they look at their home in terms of how long they'll live in their house. Because what I'm saying is this: quite often, the money portion that is allocated to stocks is not for consumption next week or next month or even a year or two from now. And you have to put a relevant time perspective to the investments in stocks. So if you're, let's say you want to be in your house for 15 years, well, you don't want somebody showing up at your doorstep saying, hey, buddy, good news, the house is worth 10% more today, and then coming back tomorrow, oh, bad news, is down 10%. You don't want that, because I'm going to be in this house for 15 years. I don't really care what happens to it today or tomorrow, because I won't need to do something about it for a long time. And in investing, what I think advisors and should do, and clients to begin with, is put a relevant time frame and be able to zoom out, not only on a monthly or daily basis, but even if you look at 2 years. When you look at 2 years in the stock market, you see there's a certain level of choppiness. In fact, you're not quite on the roller coaster, but you may be like you're a little bit at the gate, and you do see there are some downturns and upswing, and it looks pretty choppy. But if you zoom back, and instead of looking at, let's say, the last 2 years, now you look at the last 5 years, the ride becomes a little bit different. It's a little bit smoother, still choppy, but not as choppy. And then if you can put the right time perspective to when you actually need the money, I think that would really help people understand that it's okay for these to fluctuate. That's the reason I get paid more in stocks than bonds. But what I do need to do is zoom out and really understand, when will I need this money? Because if I do need money in the short run, there is a good chance that I might have that in a different form, like bonds, for example, or cash.
Well, Apollo, this has been really helpful, and from all of us at Financial Synergies, I want to thank you and for taking the time to speak with us today and to speak directly to our clients. We always find your insights incredibly valuable, and I'm sure our listeners do as well. Hopefully next time we speak, it will be under better times, better circumstances. But we want to thank you again very much.
No, I want to thank you, so much. And I, maybe like as a final thought, we're obviously talking about markets and answering questions about economics. But most importantly, I really want to wish you and the team and all your clients, everybody, to stay safe and in good health for you and your family. And because that is ultimately the most important aspect of this crisis. Let's all get through to it. And on that note, as I said, I think I have the deepest respect, gratitude, and appreciation to everybody who is going out there to help all of us get through it, and particularly the healthcare workers on the front lines. They are the heroes who wake up and go to work to help people, and they know the risk on their own health and their families, and we can't, thank them enough for the precious gift of the world. And also want to thank you, Synergy, on the for the partnership, and to all your clients for the trust that you placed in us. We're here to serve you in good markets, also in challenging ones. And as a firm, we're very healthy. We're very actively engaged in the markets every day, even as we're operating 100% from our homes. And our firm is in great shape, and we'll continue to work alongside Synergy to help all of you accomplish your financial goals. So thank you for the time and the trust that you placed in us.
Well, I couldn't have said it any better, Apollo. You've been a great partner, and just stay safe and healthy, my friend. We'll talk soon.
Bye-bye.